Today let's learn some more journal entries. First of all, let's take up the central sales tax, that is the journal entry related to the central sales tax. Now, central sales tax, whenever central sales tax is collected, right, in that case, we'll write cash account debit or debtor account debit to sales account, right? Central sales tax is collected when the sales is made to sales account with the amount and to CST, that is central sales tax account. So this is basically being the sales made and CST collected, right? Now after that, when the CST is collected after that at the end of the year, or whenever the CST is deposited, right, in the government's account. So the person who is collecting the central sales tax, it is his responsibility to deposit the central sales tax in the government account. So at that time the entry will be central sales tax account debit. Now it will be debited to cash or bank account. To cash or bank account. This is basically being the CST collected and deposited in government account, right? So these are the two entries pertaining to the central sales tax. When the CST is paid on purchase, that is, the company is purchasing some goods and they are paying the central sales tax, it is debited to the purchases account, right? So it is included as a cost, it is debited to the purchases account. As far as when we make sales is concerned, these are the two journal entries for central sales tax. Now the next thing that I'd like to discuss here is the value added tax. So the journal entries pertaining to value added tax. Now here the first point is when VAT is paid at the time of purchase. When VAT is paid at the time of purchase. Now here it is purchases account debit. Purchases account is debited. Whatever value added tax you are paying, that is VAT paid account, will be debited, right? And to cash account or bank account or creditor account, right? This is being the purchases made and VAT paid. So VAT paid account is debited when you make a purchase because you are paying VAT at that stage, right? The second one, when VAT is collected at the time of sales. When we are selling something, at that time we are collecting the VAT, right? So there, when you sell something, it is basically cash account will be debited or bank account will be debited or the debtor account will be debited, right? To sales account, and here you will write to VAT collected account. Whatever value added tax you are collecting, that is always credited, and whatever value added tax you are paying, that is always debited, right? Now the next important thing here is when VAT is paid to the government. When VAT is paid to the government, whatever VAT has been collected that VAT is paid to the government. Now here you see, we put it like this: VAT collected account debit to VAT paid account. This is basically a company maybe making sales and also purchasing goods. So when they are making the sales, they collect the VAT, and when they are purchasing the goods, they pay the VAT, right? So basically here, whatever is the balance, like, see, being the balance in the VAT paid account, transferred to VAT collected account. Here we are offsetting that. So basically, if I have collected VAT, let's say for 10,000 rupees, and I'm paying VAT of, let's say, 8,000, right? So out of that 10,000 which I have collected, I have already paid the VAT as 8,000. So whatever is the balance, that is paid back to the government. So here we will have the next one. First of all, we will transfer this. VAT paid account is transferred to the VAT collected account, and then we will write VAT collected account debit, that is whatever is the balance in that, right, that will be paid, that is paid to the government, deposited with the government. So then you will put this entry, right? So here it is, being the balance in VAT collected account deposited in the government account. So this is how VAT is treated. These are the journal entries pertaining to value added tax. So what you have to remember here is, when we make a purchase, we pay the VAT, and when we make a sales, we collect the VAT. VAT paid is always debited, VAT collected is always credited. And finally, at the end of the year, VAT paid is transferred to VAT collected account, and if at all there is a balance in the VAT collected account, that balance has to be deposited in the government account. Okay. Now I'll take up one or two more journal entries. Okay, let's take up the entries pertaining to income tax. We have seen central sales tax, we have seen value added tax. Now let's see the journal entries for income tax. When income tax is paid, at that point of time we write income tax account, which is an expense for us, right? Debit to cash or bank account. This is being the income tax paid, right? Okay, after that, this is income taxes paid. This is something which is treated as the drawings of the proprietor, because it is not related to the business. It is not something which is an expense of the business. It is basically for the individual, right? Okay, so now the next entry you will make is drawings account debit to income tax account. To income tax account. In the first one, we have paid the income tax from the business, but then you are transferring it to the drawings account, because this is basically pertaining to the proprietor or the partners, right? So here I'll write being the income tax paid transferred to the drawings account. Then the entry relating to outstanding expenses. Now let's see this outstanding expense, whether it is outstanding salary, outstanding wages, whatever it is, outstanding insurance premium. The supposing we have outstanding salary here, outstanding salary amounting to rupees 10,000 rupees, right? So here we'll put salary account debit to outstanding salary account. If it's wages, we'll put wages account to outstanding wages account, like this, right? In case of prepaid expenses, the entry will be prepaid expenses account debit. Like suppose I have prepaid salary, right? Prepaid salary account debit to salary account. This is what we do for outstanding expenses and prepaid expenses, right? Now I'll show you one more journal entry here. This is for depreciation charged on asset. When depreciation is charged on asset, we put it as depreciation account debit to asset account. Then interest on capital. Interest may be given on capital to the proprietor or the partners, right? This is basically an expense for the business. So interest on capital account debit to capital account, right? That is added to the capital. And when you have interest on drawings, here the proprietor is paying the interest on the amount that he has drawn. So this is basically, the entry will be drawings account debit to interest on drawings account. This interest on drawings is income for the business, right? So it will be like this. Depreciation I took up here. Depreciation is basically the fall in the value of an asset, so it is in a way a loss to the company because the value of its asset is falling, right? So these are some of the important journal entries. And now in our next session, we'll be looking at some examples wherein we'll be taking all these transactions that we have discussed in this session as well as the previous sessions, and we will try to do a comprehensive question where we'll write down all the journal entries. So with that, I would like to end this session. Bye.